Hello, welcome back. We're moving on now to look at the rules concerning the issue of shares. So, as we've said before, directors have the authority to issue shares, but they have to get that authority from somewhere. They can only do what either the company's constitution or the Companies Act authorises them to do. Well, the basic rule, there's kind of two bits to it. If you are a director of a private company, so not a PLC, and you've got only one class of shares, so probably just ordinary shares, then you have an authority to issue shares. Nothing else needs to happen, provided the company's articles don't try and change that position. In all other circumstances, so if you're a PLC or if you've got more than one class of share, more complex share capital, then you need to have authority to issue shares. So that authority is given either in the articles or by an ordinary resolution. And a dirty trick of the examiners, if an ordinary resolution will suffice, pretty likely a special resolution will as well. Now, that authority, it has to be quite precise. It has to have a time limit, and that time limit can't be more than 5 years. So if you want a sort of ongoing authority to issue shares, you do have to keep renewing it. And that authority will say how many shares can be issued. It might even say the price, it might even say who they're going to be issued to, but it must have the time limit and the maximum number of shares in question. Now, the funny thing there that you need to remember is that it's only an ordinary resolution. Now, in my head, I always think that should be something really important, therefore it should be a special resolution, but that's not the case. So it's a slightly odd one to remember. Now, a couple of terms to remember. You may have seen these in your practice in the office, rights issues and bonus issues. In both of these cases, the company issues new shares to existing shareholders pro rata to their existing holding. So, for instance, if you have 10 shares, you might get one new share for each 10 that you hold. Okay, now the key difference between a rights issue and a bonus issue is that in a rights issue, the company will write to you and invite you to buy these new shares. In the case of a bonus issue, those shares are sometimes regarded as free shares. They're not really free, it's just that the company has actually paid for them out of the capital reserves of the company. So instead of paying a dividend, they're using their reserves to pay up the bonus issue. Now, when a company wants to issue new shares, there is a statutory right of preemption. Now, we've referred to this before, but what is it? Well, in essence, it's a right of first refusal for the shareholders. Let me give you a scenario. Imagine that you are a shareholder in a company that has 100 shares in issue, and you own 26 shares. Now that's a good number to have because that is enough to block a special resolution. Remember, you need more than or equal to 75% of the votes. So that gives you a certain amount of power. Now imagine your company issues 10 new shares to a third party. You no longer have 26% of the company. You still have 26 shares, but those 26 shares are now 26 out of 110 shares. They're actually a little under 24%. So not enough to block a special resolution. Now, you might be a little bit upset about that because although you haven't actually done anything, you've lost some of the power that you used to have. So the preemption rights give you a right of first refusal. So if new shares are to be issued, you could have the option to say, well, actually, I want to keep my 26% ownership of this company. And to do that, I would need to increase my shareholding to 28, possibly 29 shares in this company. So I will buy 2 or 3 of the new shares in order to protect my position, to prevent me from being diluted by the new share issue. Now, the preemption rules apply to quite a lot of circumstances, but not all, as we'll see in a moment. But if a company fails to apply the preemption rights when they should have done, that gives the shareholder the right to seek compensation. It doesn't mean that the new shares that were issued are not valid. So what is this procedure? Well, it's dead easy. The company, first of all, has to offer shares to the existing shareholders on a pro rata basis. So in my example, my shareholder should be offered something round about 2.6 shares to help him maintain his position. The shareholder then has to be given a period of time to reply, and that period has to be at least 21 days. If he doesn't reply, or if he doesn't actually accept all of his share offering, then those shares can be offered to someone else. Now, key point there, they must be offered on either the same or not less favourable terms to other members, because you're going to be quite upset, aren't you, if you can't afford to buy your 2.6 shares at the required price, if you then find out that they were offered to an independent shareholder at a lesser sum. So, I said these rules don't always apply. They don't apply to bonus share issues. They don't apply when the shares are being issued for non-cash consideration. What does that mean? Well, it could be where shares are issued in exchange for a transfer of goodwill, maybe for services provided by an employee, or maybe for the transfer of a property to the business. Other exceptions, the employee share schemes. And finally, if the articles or a special resolution exclude the preemption rights. Now, a private company can permanently disapply preemption rights in its articles. Makes things really simple. A PLC can't do that. A PLC can only go the special resolution route, which means that on each occasion that it wants to disapply the preemption rights, or possibly even when it gives the directors the authority to allot shares by ordinary resolution, it can add on to that a power to exclude the preemption rights, but special resolutions needed to do this. Now, preemption rights do get tested and they are important, but the following two rules are incredibly important to your studies. The rules about issuing shares at a discount and at a premium. Now, the basic rule is you cannot issue shares at a discount to nominal value. That is an absolute no-no. You don't do it. So if it's a £1 share, then the shareholder must pay £1 for it. So a £1 share must cost £1. That sounds kind of obvious, doesn't it? But don't mix that up. We're talking about the nominal value here. That has nothing whatsoever to do with the market value of a share. So a share may be stated to be a £1 ordinary share. That £1 is the nominal value. The market value of the share could be £10. That is the amount which someone is prepared to pay to buy the shares. Okay, so don't mix it up with market value. And also, you must note the difference between issuing a share at a discount. So that would be the case where someone pays 90 pence for a £1 share, and the case where a share is issued as partly paid. Now, this would be the case where you pay 90 pence for a £1 share, but you agree to pay the 10%, the 10 pence that's outstanding when the company asks for it. Now, it's a very small difference, isn't it? Except this promise to pay the extra bit makes all the difference, because that means that we have a partly paid share. You've paid part of the price over and you'll pay the rest later. That's okay. That is legal. Getting a share for less than its nominal value with no promise to pay the extra, that is not legal. And the consequences of issuing shares at a discount is that the shareholder must, when the company is wound up, if it can't pay its debts, the shareholder is liable for the balance of the unpaid share price plus interest. In the case of a partly paid share, the shareholder is still liable for the balance because he's agreed to pay that extra 10 pence over when the company asks for it, but there will be no interest there. Now, you can't issue shares at a discount to the nominal value, but you can issue shares at a premium to the nominal value. So again, let me give you a little scenario. Imagine that A and B set up a company and they each buy 50 £1 shares. after a year or so, the company's doing okay, and C joins. Now, they want to have equal stakes in this business, so C wants to buy 50 shares as well. So the company want to issue 50 shares to C, and they're going to be £51 shares because everybody wants to have the same sort of share. However, that's not really fair, is it? A and B have invested their money into the business. They've worked in it for a year. They've invested their time, their effort. The value of the company has gone up. So what we need to do is to make sure that when C buys into the company, he pays something closer to market value for his shares. So we're going to give him £51 shares, but he's going to pay for those shares, let's say £5 each, because that represents the current market value of the business. So he's still going to have a £1 share, but he's paid 5. That is a premium. So £1 is his share capital, and the remaining £4 is the premium. And that's perfectly acceptable and a reasonable way to do business. Now, we have an example here just to show you the accounting entries. Because if a share premium is paid, that is treated in a special way in the company's accounts. And it's very hard to remember this. It goes into the share premium account. So the share premium is recorded in the share premium account. So if a company allots 100 £1 nominal shares for £1.50 in cash, that means we've got £1 is capital, 50p share premium. So before the share issue, the balance sheet would have shown that the company had £100 of cash and £100 of share capital. So it's pretty easy. After the share issue, it's going to have received 100 times £1.50, so an extra £150. It's now got £250 of cash, and that is reflected as £200 share capital, and then 100 times 50p gives you your £50 of share premium. Why is that difference important? Well, the share premium account can be used for slightly more purposes than this company's capital account can be. So, what do we know about the share premium account? Well, just like the capital account, we can't use it to pay a dividend, we can't use it to write off formation expenses, and we can't use it to deal with debenture expenses. But we can use it to cover expenses and commission on those shares. We can use it to pay up bonus shares. Now, the reason for that, if you think about it, that's just an accounting entry, because it was previously share premium account. Following a bonus issue, it will be recorded as share capital. So we've just moved it from one capital account to another. There are also some very complicated rules that apply to group reconstruction and mergers. Don't worry about those. You don't need to know them. Just need to know that they're there lurking in the background. So you do need to know what are the uses of the share premium account, unfortunately, and this list is important. Now, if we're going to issue shares, you need to be paid for them. And the Companies Act says that shares need to be paid up in money or money's worth. Now, money's worth includes goodwill, transfer of assets, or even know-how. So basically services provided to the company. Now, there are a couple of important rules though. And these are slightly different depending on whether you're looking at a private or a public company. So for a private company, first of all, the rule is that the company must make sure, the company directors must make sure that they're getting the sufficient price, a reasonable price for those shares. So they should be broadly comparable. However, the courts generally don't look into this unless it really is, as it says there, blatant and unjustified. Blatant and unjustified. In which case, if a shareholder complained to the courts, the court would declare that asset transaction invalid. However, occasionally directors will use this to sort of give a few free shares maybe to a new director, something like that, but only ever so slightly. Now, the company could receive cash. We like that. An undertaking to pay cash at a later date, but that must be paid to the company. So you can't do a sort of I'll pay him and he'll pay you and he'll pay them. It has to be payment to the promise to pay the company. Cheque is treated the same way as cash. Or release of a debt. That's what that last one means. But if you're a public company, there are some more restrictions. First of all, if they are subscriber shares, now that means basically the first shareholders are the subscribers to the company, the ones who are named in the subscription documents. On a listing, they are the ones who will receive the first share issues when those shares are first floated on the stock market. So subscriber shares must be paid for in cash, so no payments in lieu. Cannot be an undertaking to perform work in the future, so it's much narrower. And any undertaking to pay in the future must be within 5 years. And then this point here, we said that for a private company, the courts are fairly relaxed. They'll go on a reasonable estimate by the directors. But if it's a PLC and you're taking non-cash payments, then you must have an independent valuation by a qualified valuer as evidence that you've actually taken the right amount in return for those shares. Now, one other point there that I've skipped, we've mentioned this before. When shares are issued in a PLC, there is an extra rule. And the rule is that the shares must be 1/4 paid up. So although you can still issue the shares partly paid, you must have at least 1/4 of the value of those shares paid. So if it was a £1 share, we'd want to have 25p on each share paid up at the date of issue. In addition to that, let's imagine it was a £1 share and it was issued at a premium of £1.50. Well, in that case, we'd want the 50p premium plus 25p paid up. So the minimum amount to be paid would be 75p. Okay, and that particular rule there, the quarter paid up rule, the examiner quite likes that one. So you have to like it too. Now, we've got a question here. Have a go, see how you do. So, the directors of Starwake PLC, you've got to get into the habit of noting whether you're dealing with a PLC or a limited company. They want to allot 1,000 shares with a nominal value of £5 each for cash. We like that? So, first of all, can the company amend its Articles of Association to exclude the statutory rights of preemption? Well, the answer to that is no. Only a private company can do that. Is an authority to allot shares given by an ordinary resolution sufficient? Yes. The examiner's trying to con you into thinking that you need a special resolution, but that's not the case, remember. This is the slightly odd rule. Can the shares be issued for £4.50 on a fully paid up basis? Well, I really hope that in that one you saw straight away that's a proposal that the shares be issued at a discount, and the answer to that is no. If they'd said, could the shares be issued for £4.50 on a partly paid basis, i.e. with the other 50p still owing, that would have been okay. Can any of the shares be sold for £5.50 each? Well, absolutely. That would be issuing the shares at a premium, and we're quite happy for that to happen. Okay, so how did you do there? Hopefully not too bad. Okay, the final section I want to look at in this lecture is about the transfer of shares. If you want to sell your shares, you want to transfer them to another person, even give them to your spouse or to a friend, how do you do it? Well, if there's anything in the company's articles that deals with this point, you will have to follow that. And quite often there are restrictions on transfer, particularly with an owner-managed business where perhaps you don't want some third party that you don't actually know moving in to take over the business. Now, if they are unlisted shares, a share transfer is very easy. It's a stock transfer form. You buy that form from legal stationers, you fill it in, you get the share certificate and you send it to the company secretary to be registered. And once the company's seen that, they should register the transfer. If they can think of a reason to refuse to register the transfer, perhaps because the forms aren't properly carried out, or perhaps because it contravenes a provision in the articles. They have to let the shareholder know that that's the case and say why. Again, I've seen the examiner test this. It's a mean question, but if your shares are transferred on bankruptcy or death, then they don't actually get transferred under using a stock transfer form. It happens, as we say, by operation of law. That means they are automatically deemed to belong to the donee, the successee, if you like, successor even, and therefore you don't need documentation for that. If you're looking at listed shares, it's actually almost simpler because listed shares are transferred under the CREST system, and this is a paperless system. So you need to contact a broker and they will deal with the transfer for you. Now, I think most listed companies are now dealt with under the CREST, and it's just worth noting there that the Treasury or the Secretary of State can direct companies to sign up to CREST. Okay, so I want to leave that there. I want to keep this lecture fairly short and snappy. The next lecture, we will look at the treatment of share capital. It's a little bit of a detailed lecture coming up. So have a coffee now.